Well, first and foremost, welcome to rainy Seattle. I thought I'd have better weather. An hour ago, I was in a short sleeve shirt and jeans thinking we do a Sundance. But in all sincerity, thank you guys for coming today. Welcome. Appreciate your support of Forum, being our investment partners, and being our friends and supportive of all of us. I'd like to change it up a little bit this year. Those of you that were at the Denver Country Club with us last year, it was more of a presentation walking through a PowerPoint, all the statistics. And this year, we're going to change up the agenda. We really want to make this interactive, encourage you guys to engage with us with questions. We are going to run through some statistics and some data so that you guys know what's going on, although the quarterly reports typically give you all the information. If you don't have a packet, some of you, it was mostly meant for the people in the back row. There's a packet that we can pass out so you can read some of the slides that we do have up here. The agenda today, we're going to do a quick presentation. Luke Davis, our COO, as well as Head of Acquisitions and Asset Management. Kevin Foltz, who runs our development group. Brian Schumann, our pencil pusher, the CFO. And Jeff Ogden, who runs capital markets. So, on top of that, Kristen Burton is our business manager here at Kent Place. We decided to have it here. Beautiful setting. We just completed this property. I figured it'd be a good place to have everybody and have some great food and meet some great people. So the networking session right before this, hopefully you were able to meet some great people. It's 6 o'clock. We'll have tours starting at 6:10 if people would like to do a tour, and every 30 minutes from there on, and it'll go till 8 o'clock. After our quick presentation, we're going to do a 30-minute Q&A. We'll have 3 people in the audience with microphones, so I do, again, hope you guys engage with us and ask questions. I've got some tough questions for the guys up here, as well as those of you that have sent me questions. We'll be firing those, so I hope you guys are ready. Next, Lee Bland, one of my longtime partners, is not here today. She had a medical surgery, but like to say a great thanks to her for helping us put this together. Couldn't do it without her. We'll also see Greg Litvak, who's an asset manager, back here somewhere. Stacy Valentine, one of our senior regional managers. Lucy Fernandez. Sherilyn Keeling, who's our chief people person, another way of saying HR. So rather than introducing everybody, I'd like you to introduce yourselves as the program wraps up here. Moving on here, we'll get into this. Let's see here. A couple more advisors. Edie Sewer. Edie is our general legal counsel. John Woodward, he handles a lot of our 1031 transactions as well. Chris Sharp is here. I think John's golfing somewhere in warm weather. Jay Jester handles all of our operating agreements and partnership agreements. And last but not least, Daryl Dishler, who was the hit of the parade last year at our conference, will be talking tax. And so in your packets, you'll see some K1s. Very informative, I think it'll be for those of you that need some help on the tax side. So some of you may or may not know, we have something internally called our Commitment to Great. And our Commitment to Great is really the DNA that we live by internally, how our team transfers that down to our properties, how we exceed expectations for all of our stakeholders. So our stakeholders are each other that we work with you as our investor partners, as well as our on-site teams and our vendors. I heard from some of you last year questions that we posed, and I think what I took away from the questions that were asked last year is really, Darren, what are you doing to build a lasting organization? And as you'll see as we go through this, we took that to heart. The definition of Forum, as you can see up there, is a medium for open discussion, and really like the feedback from you guys on how we can get better. So what have we done to create a lasting organization? A lot of people don't like to hear me say this, but I say, hey, if I get run over by a bus, I don't want everybody looking and saying, hey, what are we going to do now? So in order to build that lasting organization, we've started, and you may have noticed this on our quarterly reports, our asset managers are now signing those reports and trying to engage with all of you rather than me doing it directly. Investment committee, that was another question last year. Our investment committee now, what we do is we have our regional managers, our head of maintenance, our asset managers, head of development. We'll have 9 people in the room. We'll go through a deal that we're either going to buy potentially or develop, and we have to have a quorum on the vote. Another thing that I think you'll appreciate is we try and become one team that promotes from within. To bring up a culture that is very important to us, rather than bringing outsiders in, the hardest part of our business is people. And finding those people that we can train and bring up from a regional manager to an SVP, we want them really to understand and learn our culture. I think the main goal is, as you invest with us, I want you to think of this as an investment for a lifetime. If it's something that you pass on to your kids, you still feel comfortable investing with Forum, knowing that I'm not the hub and spoke telling everybody what to do, but that we've found a lot of smart people to be our partners and run your investments. Forum Management, Inc. It may sound simple. Rather than me signing all of our loan docs, operating agreements, et cetera, we now have Forum Management, Inc. We have a president, we have a secretary, we have a vice president. Again, if I know Brian doesn't like to hear this, I get run over by a bus, we're not going to hold up any process for our investments. And lastly, an advisory board. We put together an advisory board about 9 months ago now. You'll see their good-looking faces here. Rich Sherberg. Rich comes from a background, he's 30 plus years in the business, land development, vertical development. Gary Arthur, former CEO and CFO in the real estate business, as well as Les Bakel. I didn't take his picture, by the way. Les comes from the acquisition and disposition side from UDR, which is one of the largest apartment REITs in the US. So, move on here. Give a little overview. So investing with us, I like to say we're in the business of investing, not the investment business. And I think there's a real distinction to that. If you're in the investment business, you're getting paid to put money out. When you're in the business of investing, you're getting rewarded by finding good investments. We're not a fund. We don't get paid. We don't have a timeline. I think as you hear some of us speak and some of the questions, you'll realize we like to say we want the market to come to us, not go to the market. Very patient, if you will. So we're proactive, uphold a consistent strategy, but we adjust our tactics, okay? Our strategy is we want to find marquee development sites like this location here at Kent Place, and we want to find long-term dependable cash flow. So on strategy, our strategy will always stay the same. Our tactics, as you hear, as we start buying newer product, you'll see that is one of the tactics that have changed. We manage risk. You've heard it before, long-term debt. There's no way to time the market. Real estate's a long-term investment. Our minimum debt is 10 years of fixed rate. We try to have high debt service coverage so we don't get in trouble. We think forward. There's a book out called How the Mighty Fall. They talk about Motorola. They talk about the Palm Pilot. The Palm Pilot, Motorola, that was the first cell phone, the first PDA. Palm Pilot's not even around anymore. We have to continue to have great vision, find new technology and new ways to market our assets. Invest with you. Invest in assets that generate long, thorough, recurring, dependable cash flow. Everybody knows our MO. You know the old saying, cash is king, but cash flow is queen. We want to wake up next to the queen, have a check coming in. That's what our goal is. How we deliver returns. So we see real estate investing a little bit different than most people. We don't require significant market timing in transactions to deliver our returns. On the left side, you'll see what I call the highly predictable things. That's cash flow. Today's market, you're probably looking at 8 to 12%. When you're amortizing your loan, that's another 2 to 4% on your equity. And then rent growth, depending on what market. Rent growth can be 2 to 4%. Denver, it's been closer to 9 or 10 over the last couple of years. The less predictable are appreciation, market timing, and a refinance or sale. And we do target 20+% returns. Our focus. I like to say nothing we do is in mass or status quo. We're unvanilla, if you will. Through the places we buy and build, we want to create a different experience. Something that's valuable to our shareholders, something that differentiates us from the competition, and something that's meaningful to our residents. If we have 4 properties on the same block, how do we differentiate ourselves? Service, cleans free, customer service is free, and we just hired, it's a first for us, a brand manager. Teresa Hansen in the back just joined us this week. Everybody wants to be a part of a brand in life. They may not know it, whether it's a cult, whether it's you like Starbucks, whether what you dress, what religion, you want to be a part of something. So what we ask is when somebody comes to Kent Place, a potential resident, they have 2 things they can say when they leave. Why should I live here? Or how do I not live here? When you do a tour of this place, I think you'll agree, you'll say, how would I not live here? Big difference. So what are we doing to differentiate ourselves? I just, kind of like a kid, bought a drone, and I'll show you guys what we're doing for all of our properties. Interrupt the sound. So think if you were a potential resident and you were getting on a website, first thing people do when they go to look at apartments, they get on a website, right? See how it looks? What if you start with a drone and you understand what's all around you? This is a property called the Logan that we actually built and sold. But we're going around and doing this for all of our assets. Turn the volume up a little. Also, as you have video, there's something called SEO for those that you know when you search on Google. So when you start having videos like this, it rates you very, very high. Then have a virtual tour of the property. Pretty cool. I think it's a good way to differentiate ourselves. Working on brand is a big push for us, understanding the who. Who's our demographic? Why they live here? What are they doing? Why do they have to live at Kent Place? That's what we're focused on at each property that we have. So without further ado, I'm going to turn it over to Brian Schumann, our CFO.
Thank you, Darren. Can everyone hear me okay in the back? So I'm going to talk about 3 things, and we're going to go fairly quickly because we're going to have the Q&A at the end. I want to talk a little bit about our financial performance, how we're doing now, how we're comparing to last year. Talk a bit about the growth of Form portfolio, the genesis of the assets, origins, and then I'm going to talk a little bit about how we look at assets at Form. How do we think about, how do we consider harvesting the value of real estate? And I apologize, some of the numbers may be a little small in the back, you may not see them, but I think the chart's fairly clear. This is our 2015 performance so far for the entire portfolio. We have about 4,500 multifamily units in the portfolio. Revenue for the quarter, we're at our budget for the year. Net operating income, we're exceeding it, and free cash flow, we're doing exceptionally well compared to budget. This was a challenging budget, and as you'll see in a moment how it compares to last year. Important metrics that we use, you'll hear from Luke, you'll hear from Kevin, Jeff. Net operating income is a key measure on how we value real estate. Cap rates, it's part of that calculation. At the end of the day, free cash flow is, as Darren had said, that's the queen. That's really what we're trying to accomplish here and providing equity returns to our investors. Free cash flow into what you're investing, that's our equity yield, and we'll talk about that a little bit more. But we're on track for 2015, and I bring that to your attention because it's substantially better than 2014. This is a same-store portfolio, and by that I mean those assets which we owned last year for the entire year as compared to those assets we're owning today. So it's an apples to apples comparison. Doesn't take into account growth because of acquisitions. Economic occupancy and vacancy, much improved over the year. As the CFO, I focus highly on the economic side of it. You'll hear about occupancy being physical, heads on beds, and that's very important. But at the end of the day, what drives cash flow is everyone paying? Are they paying what we expected them to pay? We're up 4% year over year. Total income's up 5%. Our margin, and I don't have a pointer here, but you can see this in the middle, our operating margins have gone from 40 to 44%. That's a 10% increase in operating margin. Revenue less operating expenses is the operating margin. Free cash flow, therefore, is up 21% year over year, same properties. Now, we've got to hit those numbers for 2015, but as you saw from Q1, we're already achieving that. We're working on our expenses, and net rental income per square foot is increasing. The portfolio is at 79 cents last year, 83 cents this year. By comparison, though, this property, Kent Place, we're about $3 a square foot in net rental income. Veranda down the road, about $1.85. So this is a blend for the entire portfolio. $4,500 units. You can see the red is the acquisitions. This is Form's development of the portfolio over the last 5 years. In 2010, we had less than 500 units developed. We've grown from that to 4,500 units, largely on a unit count by acquisitions, but I don't want us to think of ourselves just as an acquisition organization. When you look at it from a dollar standpoint, the invested dollars that you and ourselves put in, you can see that it's pretty even. Acquisitions for the last 5 years, we've put in about $240 million of assets under management. Development, about $260 million, so fairly even. Less units in development, same amount of invested dollars, and that's because, as you can see in the gray box, our developments are about $230,000 a door to build. Our acquisitions are closer to $70,000 per door. So while we might have more acquired units on a dollar per dollar basis, it's fairly even. We have some other commercial activities as well. But all told today, Form has close to $800 million of asset under management. So we're getting close to that $1 billion mark. But how do we think about the real estate? How do we think about the portfolio? Darren had talked about looking at different markets. He had talked about looking at different products. Here's an example, and we do both. We're looking for assets that are in moderate growth markets and also in lower growth markets. Why? Well, a lower growth market will probably have a larger cash-on-cash return out of the box. So you can see in that middle column, a $100,000 investment in a low growth asset, we can probably do a 12% cash on day one. But over 10 years, that 12% will grow to about 13. We've had growth, but not a lot. It's not very volatile. It's just going to stay nice and steady there. Well, we've got a couple choices now. We're 10 years into the asset. If we still like the asset, if we still believe in the market, if we still believe in the fundamentals, we'll likely refinance it. A low growth asset at 2% is going to turn that $100,000 investment to about $117,000 in distributions. So we can distribute on a refinance or a supplemental $117,000. It's a great return. That provides you about a 25% annualized cash-on-cash return. But now that we're taking money out of the asset, we're taking on more debt, we've got to be able to return a 3.4% return to you, where you're going to find it elsewhere so you can keep your distributions even. And that's a low growth opportunity. The moderate growth opportunities, secondary markets, newer assets, 4% growth, will probably have a 9% cash out of the box, but that's going to grow almost 20% over those 10 years. And if we decide to refinance it, we'll almost double that money to a 30% annualized cash on cash. If we were to sell the property, those proceeds would be 3.5 times the initial investment. So we do this not because either one's better or worse. We'll be looking at both, but there's different measures of success, and depending on the market, we like to blend them both ways. That's that's a bit of an abstract. Let me talk about some real-life activity. On our left is Town Park. It's a property in Birmingham, Alabama. We own it today. We'll be selling it next month. We like Birmingham. We've got assets we're buying in Birmingham. But in this submarket, we think the market's done pretty much what it's going to do. The original equity was just under $3.3 million. We're going to distribute almost $5.8 million on a sale. That's 177% of the initial equity from the sale, and including the distributions while we owned it, that's a 2.1 times multiple at 210% equity returned, 51% average annual cash on cash. It's a great return. We're selling that asset because we think that submarket has tapped out and we've done the best we can do. On the right, Retreat at Farmington Hills, Michigan. We like that area. We like that market we're buying. We like it enough that we want to stay there. So rather than selling the asset, which was originally $7.7 million of equity, we're taking out a $6.65 million supplemental loan, tomorrow in fact, and we're going to be distributing out $4.6 million to the investors. That leaves essentially $3 million of your initial equity in. So 60% of what one had originally put in, they'll get back early next week just because of this supplemental. That, in addition to the distributions we've already made, would mean that the investor has received 91% back of their initial equity and still has an ownership stake in the asset. The investment will continue to turn off a 10% cash on cash or a 28% when your remaining equity. If we're not buyers, we're sellers. We look at the assets continually and in a very objective manner. We're trying to be very thoughtful about this. This isn't just, hey, the market's hot, what do we do? On a quarterly basis, we're looking at how's the market performing, are the dynamics what we expected them to be, and what's the best we can do for our investors? And then depending upon this, how can our investors reinvest, whether it be through a 1031 that we'll talk about later, or anything on your own, so you can continue to get your quarterly distributions. A lot to take in. I'm trying to go through quickly, but that's how we think about it. That's how we think about mining the value we create in our portfolio. Any questions? We'll have more Q&A later, but anything I went over too quickly? Okay. With that, I'd like to turn it over to Kevin Foltz, our head of development. Thanks.
Thanks, Brian. So many of you might be asking, especially in light of the rains and the snow and all the challenges that we're facing right now, why are you developing? And why should we be investing in new ground-up developments? I think the answer is fairly simple. It's value creation. And value creation comes, for us, primarily in selecting irreplaceable locations in these primary markets with high barriers to entry. That's where we look first and foremost in our value creation strategy. We also build at a lower cost than the immediate market value, and that's what helps create the realized and unrealized gain. Right now, you can see here across our development asset portfolio, we're averaging about 56% in total annualized return. Again, realized and unrealized across the development assets. Of course, you're also receiving cash flow through distributions and refinance proceeds along the way. So where are we going to find these irreplaceable assets, irreplaceable locations? Well, right now, we're in Colorado and Minneapolis, or Minnesota, where we have 12 properties that we've developed and approximately 1,500 residential units. But now we're looking in other markets. We're looking at submarkets in Texas, Arizona, California, and up the coast, because we believe that there's tremendous opportunity there where rent growth is outpacing construction costs. And we'll talk about construction costs as a huge barrier in a moment. But we recognize that those submarkets may be experiencing the same risks, and multifamily in these markets may be at its peak. So we dig into each one of these submarkets and identify specific locations to understand what the highest and best use is for those submarkets and those specific locations. It might be residential, it might be commercial, or it might be a combination of each. We also then dig into the demographic and psychographics of each specific location. We treat each location differently, and we do a comprehensive brand narrative of each of the locations and the core characteristics of each location to identify the target submarket within that location. This is what makes Forum different. Our strict dedication and attention to branding and our deep dive into the demographic long before we start any design. We call this understanding the who. Darren mentioned it earlier. Who are we targeting and what do they want? From before design, before even pencil hits the paper, we'll go into the neighborhoods, we'll talk to the residents, we'll sit in the coffee shops and ask the residents, what do you want? What are you looking for? What are you missing in your community? And those are the things that we want to bring and be unique to each location. For example, at Kemp Place, months before we started designing this building, we did just that. We understood the who. We broke it down into 5 or 6 distinct groups so that we could get a good starting point. And from that starting point, we designed everything what you see around here. If we would have missed it then, or if you miss it from the very beginning, you're likely to never recover. The other key component is understanding the sentiment, which starts with the customers, the consumers, and then translates into the buildings. This is what people say and how they feel. This is what's important in their lifestyle. Brand positioning. We say the brand is what's left after all the marketing dollars have been expended. And as Darren said, people are looking to associate themselves with a strong brand and an identity. And through these designs, through the programming of spaces and places, we help design and create and these customers become a part of this identity. And the community creates its own identity. We program the amenities that are well thought out to be useful and valued, not just a in the corner space that people will never use and might be pretty to look at. And I think as you tour this property, you'll get a sense for around each corner there's a new space that is inviting and something that you could see yourself in. Lastly, creating expressions. This is the photography, the typography, and the graphic inspiration that becomes the guiding principle for the design team. Long before this design, this is the creation of the website. This is the creation of the collateral and becomes the inspiration for the building architecture and the interior design. This also leads to amenity naming, which we feel is a critical component to these properties. We name these amenities so that it creates a sense of distinction and exclusivity of the property. And much like you'd find at a hotel or boutique or luxury hotel. But all this eventually makes its way into the underwriting. And the challenges today in underwriting, many opportunities out there, development opportunities abundant, but trying to underwrite with today's construction costs. As an example, construction costs in the Denver market are really pushing people outside the box without institutional capital, without lowering and compressing your standards. This is a good example. Our project just down the street, Veranda High Point, we started in 2012, and we built that property for $170,000 a unit in total project cost. If we were building that today, we'd be at roughly $240,000 per unit total project cost, an increase of 40%. that equates on equivalent rents to about a 240 basis point difference in return on cost. Very difficult to lower our standards and underwrite to those types of escalations. Conversely, a property that we're looking at right now in Minneapolis, Minnesota, 394, is what we like about Minneapolis is we've seen very steady but low growth in construction costs. Construction costs are now, they used to be much higher, you can see, whether it's through union labor or just that market has remained fairly flat. $207,000 a unit with higher rents. So costs have remained static, rents are continually have a healthy increase. So that's a product and a sub-market that we're looking at. There are other opportunities like that out there. We just have to be cautious and very conservative in our underwriting going forward. I'll answer questions now or later if you have anybody has any questions now. Yeah.
I thought that there was a considerable amount of building going on, so there was the influx of apartment units. Is that the case?
There are, certainly. But it hasn't affected either rental rates or occupancy rates. Occupancy still remains extraordinarily high. New product is leasing up very quickly, and rental rates continue to climb. So, and it's all relative. It's certainly not like Denver, where we've seen, we have 20,000 units in the Denver metropolitan area in the pipeline, 17 or 19,000 more to come. I think they've had a steady incline of units coming on board, but all of them have been absorbed on a very fast margin.
Rainey, I think maybe one of the things you're hitting on is at the University of Minnesota. An influx of apartments have been built, and we've definitely felt the rent pressure, at the university. They've built, I think, 6,000 beds in a 10-block radius. We're talking about 20,000 units in a 10-mile radius here in Denver. So that sub-market at the university is really feeling it. We obviously have concern about Denver and all this being built around here. The overall Minneapolis market has a 2.5% vacancy. So a little bit different than, on the whole market versus just that one sub-market in the student section. So.
Is it depressed values, though? Or?
Well, we've had a couple things. In Minnesota, the taxes are the wild card there. Our taxes, the sold house properties doubled, then went up another 22%. So we got hit because some people built and sold. More product came online. Rental concessions drove rents down in that sub-market. So we can talk a little bit further, address that with the sold house properties when we have the Q&A. So next, I'd like to introduce Jeff Ogden. I've known Jeff for, 20-some years. Jeff spent 15 years at Aimco here in Denver. He ran capital markets. Aimco had 300-something thousand apartment units. It's been great to have Jeff. I don't have to handle all the financing as well as other things. I get to work on the business rather than in the business every day. So great to have somebody with his talent and experience on our team.
Thanks, Darren. There's plenty of people in the room that I know or I've worked with or friends with, and it's a pleasure to be here, and it's great to see you all. I'm going to briefly talk about capital markets, primarily debt capital. We believe, it's a bit of a pause here, at Forum we believe in a well-balanced capital stack. What I mean by that is simply a favorable allocation of 70 to 75% of property debt and 25 to 30% of investor equity. We believe this does a few things. One, it maximizes the cash-on-cash returns to investors. By the ability to borrow debt at a below purchase price cap rate, it allows us to deliver a higher than or a more favorable return to the investors. That's this bar here on the left, where we can borrow somewhere between 4.5% from the lender, and we can deliver an 8 or greater to the investors. We also think this limits risk to the investors. As Darren mentioned, we're very much focused on debt coverage ratios. We simply go in about a 1.3 times coverage, which simply means our net operating income is about 1.3 times that of the debt service. We try to get to a 1.5 in years 2 or 3. We also like amortizing debt, as it allows us to appreciate, or it allows the asset to appreciate over time through the NOI growth and the amortization of the principal. Some other highlights of our strategy I wanted to point out here, because Brian spoke about it, is the ability to borrow from lenders that allow supplemental loans. Now, not every lender allows you to go back to the well and get a second loan. This is important for us, as those of you that are in the retreat deal know. It's important for us to borrow money a second time, to return the money to the investors, and also to help preserve the asset. I believe we've carved out a portion of the proceeds from the loan to do some projects and some unit upgrades. I've listed here the top 5 capital sources that we go to for our debt capital. I put them in a preferential priority. The top being Fannie Mae and Freddie Mac, also known as government-sponsored enterprises, or GSEs for short. Fannie Mae and Freddie Mac, we like them primarily because they lend in every market that we want to own. They lend on every product type that we want to buy or own or develop. And they provide some of the lowest cost capital that's out there. The second source is commercial or regional banks. We typically will focus on these groups for things like our Pearl Place development. PNC was a great partner, or is a great partner of ours. KeyBank has helped us on some of our repositioned assets. I think we have about 3 or 4 loans with them. Next are life companies. Life companies tend to target high-quality properties like Ken Place, like Veranda. Their focus is they are selective. They are trying to invest for their policy holders, so they do like the longer term, but their rates can be very competitive. The bottom 2 are FHA and CMBS. FHA was reliable during the Great Recession. There was a big shift to borrow from FHA just because there wasn't a lot of capital available. However, if you've ever done an FHA deal, it's very time-consuming. There's a lot of red tape. Let's face it, it's the government. It's not like Freddie or Fannie, which kind of have a 60-day soup to nuts beginning to end for your loan. FHA in some cases was taking up to 9 to 12 months to get a loan closed, and that just doesn't work. And then CMBS and conduits. The CMBS market, or lenders, I kind of treat them as a bellwether for what's going on. When the Great Recession hit, there was no CMBS lending. Prior to the Great Recession, everybody was doing a CMBS loan. We're starting to see the CMBS market come back strong. Take it for what it's worth, but that's what's happening today. You know, one other thing I wanted to point out, between the relationships that Darren and I have made over the last 15 years with all these lenders, we constantly are keeping informed and up to date as the markets turn. Recently, Fannie Mae and Freddie Mac, in the last 60 days, started to increase their pricing of debt to the tune of about 50 basis points. That was primarily due to the fact that the volume allocation that they're provided every year, which this year I believe is $30 billion each, they're going to hit about 90% of that number by the end of the second quarter. So they saw that they were running out of runway. So they've started to, what's the term? They certainly started to push their pricing, but they started to ration capital to a sense that these other lending sources are starting to come back into play. This is just a quick graph that shows the last 10 years who the dominant lenders have been. The very top gray bar is life companies. I believe that's life companies. The next 2 are Fannie and Freddie. And what I want to point out, Fannie and Freddie were there during the credit crunch. I mean, they still were lending. They're a very reliable source. And the next slide here this is our portfolio, a snapshot of what we have it for. This is multifamily only, so this does not include Pearl Place or Park DIA or Castle Rock. We have 19 properties with an average maturity date of a little over 9 years. Our average interest rate portfolio wide is 4.16%. We have 3 loans maturing this year which one of them is Town Park, which we're selling. Seasons Park, we're under app. We're going to be closing that in the middle of next month. You'll be getting a consent on that soon. And then Skygate. Skygate is targeted for a refinance probably the end of the summer, beginning of fall.
September.
And then from there, our next year exposure is 2022. So we've maintained and we've managed the risk of the portfolio. From an LTV standpoint, we're just under 60% today. As we begin to amortize that further, that'll drop as market values go up. That'll drop as well. Our coverage is 2.28 times. Again, a very solid, healthy ratio to be at. And then the two pie charts on the right, this just shows our allocation of lenders by both a dollar or loan amount and then by the number of loans. And as you can see, Fannie and Freddie take up half or slightly more than half, with the rest going to life companies, banks, and FHA. Any questions? More coming. Thank you.
Thanks, Jeff.
I guess we're supposed to use the mic.
Everybody hear me okay? Over the last 12 months, we closed 4 properties, which is quite a bit lower than we did in 2012 and 2013. And that was intentional, very much by design. The market is very hot, and we'll talk about that in a second, and I think you've heard that already from some of the other guys up here. But it's a very frothy market right now. We're seeing a lot of competition out there, and we want to be very, very careful about going into what could be a top of a market right now. The 4 properties that we closed last year were Inverness Cliffs in Birmingham, Alabama, the Mark and Turtle Place in Montgomery, Alabama, Township Square in Saginaw, Michigan, and Viera at West Chase in Tampa, Florida. And one of the common key characteristics of all 4 of those acquisitions was a strong debt coverage ratio. And when I say debt coverage ratio, for those of you that aren't familiar with that term, that's simply the net operating income at the property divided by the monthly mortgage payment. And if the two are equal, you've got a 1.0 debt coverage ratio. And generally, lenders require a minimum of a 1.20 or a 1.25 debt coverage ratio in order for them to feel safe and secure about where their collateral is and their standing is against their collateral. So if you look at the common denominator amongst these 4 assets and where our debt coverage ratio was, you can see at no point during the life of the loan, and these are 10-year loans or greater, at no point during the life of the loan do we project that the debt coverage ratio would get below a 1.50, and in fact they'll grow from there at the bottom of that. And we feel that's really important right now, given where we are in the marketplace and giving us protection as investors. Now that might mean we don't get to buy as much as we've saw in the last 12 months, but we're okay with that. It's not a great time to be diving in the acquisition world right now. If we look at the marketplace and kind of understand the why as to why we're not buying as much as we have in previous years, let's look at these bars here. And you'll notice where these are, just to go back a step, these are multifamily sales prices on average across the entire United States over about a decade or so period. And if you look at the trend here, every 6 years or so, it seems to be that we get to a top. We're feeling like we're at a top right now. Here was the one right before the last Great Recession. If you go back a couple cycles before this, you'll see a same 5 or 6 year cycle, and we're very mindful of that and where we are in the marketplace. Another metric that we're very careful to look at are multifamily construction completions. And if you look at here where we finished 2014, we had almost 250,000 units in the United States added to the inventory. And interestingly, it was higher now, last year, than it was in the last cycle by quite a bit. And then if you look back to the previous cycle before that, that peak was still a little bit lower than where we are now, but that was a more multifamily centered peak, whereas here we were more focused on single family in 2000. Construction back then. Now, if we zoom in on some of the key metrics that drive our business, rent growth and wage growth are 2 of the most important, and we look at those all the time. If you look at the red line here, that is your wage growth, and you can see that's pretty flat. It's about 2% year over year here for the last 4 or 5 years. But notice the blue line here, which is your rent growth, and you can see the gap that's occurring over the last 3 years. It continues to get wider and wider. And that cannot occur for very long. Those 2 things have to come back together. We can't keep raising rents. Those 2. If you look at the gray bar here, this is your effective monthly rent across the U.S. national averages here. And you'll notice that's pretty steady. It's about a 2.5% climb year after year after year. You'll see some flatness, maybe a little downturn here at recession points, but pretty steady. Now, compare your mortgage payment with that, and you've got a pretty healthy relationship here. Then you see a bubble back in 2007 before it crashes and actually goes below your effective rental payment, your monthly rent, back up to where we are now, which could keep our rents from climbing for the next year or so. What we're hoping to see is that get pushed back up to where we have this same equal relationship going forward. Now, this is an interesting chart here, and I want to have you focus on the gray bars that go up and down. These gray bars represent recessions for the last 150 years, dating back to the late 1800s. And if you look at where one gray bar ends and one begins, that average, if you take a 100-year period, that average is about every 4.1 years. Now, if you tighten that up and take a smaller sample size and look at every 20 or every 50 years, that grows to 5.8 years between bars. And if you tighten it even further and look at the last 25 years, that distance is 7.9 years. So if we're trying to figure out when the next gray bar is, anybody's guess, no one really knows that, but you can project that probably in the next 12 to 24 months we'll see another gray bar, another recession. And although that sounds scary, we see that as a lot of opportunity, and that's one of the reasons why we're not buying now, is there's fantastic opportunity coming that we think that we can take advantage of. I'll jump out of the window and and go that direction. Let's look at some of the positive things that are happening in the economy right now. And here, I'll have you look at all of these bars here. This is single-family new construction that's being delivered year after year for the last 25 years in the U.S. And if you look, you can see the averages are about 1.2 million units delivered year after year. And if you think back to that slide that I presented earlier, showed where multifamily is, if you recall, the high point that we were at was about 250,000 units. So single family really is the big gorilla in the housing industry compared to multifamily. We're just the little brother of them. They do 5 or 6 times what we do. And what's interesting is if you look at this big crater right here after the Great Recession, there was very little single family added. And so if you take that combined with the multifamily, we're still way under the amount of total homes added, whether they're or single family added in the U.S., which gives us encouragement. So what does that mean for us, and what are the opportunities that are out there? If you look in 2007 compared to today, 2015, the average sale price for multifamily is about 13% higher from that last peak to where we are today. Now, if you look at some of these markets, it's actually anywhere from 5, 6, 7 to 32% below that 2007 peak. So there's a lot of opportunity specifically in a lot of the Southeast and Midwest locations. That doesn't mean we can't go all in there. That doesn't mean there's no competition there. It's quite the opposite. There is quite a bit. But markets like Tampa, Detroit, some of these other markets that we're actively looking in, we see some value there as well. So in conclusion, we feel like we're at what could be the peak of the cycle. We're very cautious about what we're buying. We know that there's a lot of our competition is willing to chase deals much further than we are, and we're okay with that. We want to keep some powder dry and be ready to go all in, play good defense right now, given where we are in the cycle. So I'll leave you with one last quote here, and I apologize for you offensive-minded folks in the room. Drew Brees, sorry. Offense sells tickets, but defense wins championships. Time to play defense. And I'll turn it back, or open it up to questions.
So we have 3 people walking around with microphones. Now comes the fun, where you guys get to drill a few questions at myself, at these guys. I've got my own list of questions from some of you, and we're going to open this up to Q&A. So does anybody want to start, or do you want me to kick it off? Not everybody at once. Ron.
So you have this bad timing for probably buying rental property. What are you doing when you look at town park selling and so on?
I look at it, and I'll let others answer as well. The way I look at it is, we were clipping an 18%, cash on cash return. It was an interest-only bridge loan, great return, hard to replace that. Town Park is literally behind us are the tracks, and on the other side is the bad area, and right in front of is like the Cherry Creek. And we felt having a 1970s product, like Brian said earlier, let's ring the bell and take some chips off the table. I personally would say, look, if I can go replace that play defense, let's say I put 100 grand in, I'm pulling out 200 grand, okay? If I can go get a 9% or better return, on that investment today on a newer product in a better located area, that's, to my point, we're changing our tactic. I personally believe we'll see more rent growth buying in a better location, buy a B deal in an A location in a better market with a lower return. That's where Forum is focused right now. Anybody else want to?
I would just add that we are looking at very select markets, as we talked about. We're not, if we don't find what we need, we don't have to 1031. It would be nice to do that. But we're looking at a lot of different things that we don't necessarily have to jump into, and specifically in some of those key target markets that we showed earlier.
Here, I don't know if this is the right forum, will you guys be discussing Castle Rock and your favorite animal, the prairie dog?
Happy to discuss it. So for those of you that are in our Castle Rock deal, it's a large development down in Castle Rock, Colorado. And we had some people that thought prairie dogs should not be moved. I shouldn't say this. They're like a rat to me. And, some of these neighbors, probably, displaced prairie dogs themselves. So we actually had traps down there. We had a big vacuum machine that was sucking them out. And, you can picture Caddyshack, right? That little gopher that you could never get rid of. So we're through the prairie dog issue. There are two ladies that thought it'd be great to keep 30 prairie dogs each in their garage and keep them as pets. I would have had target practice, but it's their choice. Anyways, what's happened, the prairie dog, we're behind that part. The issue that has come up is some residents down there have got enough signatures to call it up in front of city council. What they don't realize is that if we go back to our old zoning, the only two blocks it affects are block 1 and 2, and we could potentially lose 10% of our developable land on those two, and that's potential. So it was a big PR issue that we hired a group to kind of help. City council wants to see it. You just sometimes have some people that, it's no development. It's like in Boulder. We've got a great piece of land, and somebody says, well, what would you like to see there? Well, we'd like a park. Well, that's great, but you know what? We're talking about a commercial development here, not a park. So I think we're safe on that one.
So if they can challenge this most recent zoning, can they challenge the old zoning as well?
No, so right now we're grandfathered on the old zoning. It was really block 1 and 2 that it was affected. So they can call it up for a referendum and try and overturn the existing zoning on that.
So does it delay the construction on blocks 1 and 2?
Actually, that's a great question. I would say briefly because we can't do grading and everything, so it'll be kind of, we'll probably be behind a little bit. But as we phase the property to the north, that's where Whole Foods, and they want this PR thing to kind of die down before they decide, to sign a lease and then have their name. So.
Jared, would you repeat the question? My wife is streaming. She can't hear the question.
Yeah. So the question from Jim West, is that as far as the...
Just repeat the question.
You got it. Perfect. Any others?
Darren, timing's everything in real estate. You guys have been phenomenal with your time and everything that you've done so far. Very impressive. Great to see you guys and hear what you have to say about this. Let's talk about the timing. What do you see in the future here? Where do you see these cap rates? I mean, they've been at all-time lows. Investors are clamoring for yield. Real estate's had an amazing run-up. How much longer is this going to last?
So the question for those of you that are streaming was, I'll summarize it. Are we at the top? How long is this going to last? There's a ton of capital chasing all deals. I think in any market that you're in, everybody says we want yield. I mean, everybody I talk to, we want yield, we need cash flow. I'm in agreement. You have a lot of international capital. You look at markets like Vancouver, 3 3/4 caps, 4 caps, where the Chinese are coming in and half a block is vacant. They bought a $4 million home just to plant money. We're seeing that institutional capital come to the U.S. We're seeing that institutional capital come to the secondary and tertiary markets in the Midwest. It was a lot easier in 2009 to have a shotgun approach when everybody had problems, and they were in these high trade markets like Texas, Phoenix, and everybody had problems. And we said, look, this is a great time. Let's buy this. Let's buy that. Now it's got to be a sniper rifle approach. Like I said earlier, because we don't have to put money out, it's a good thing. A friend told me once, he said, when the ducks quack, feed them. And the ducks are quacking. So we're going to feed them. And I think paying tax is a privilege. I hate to pay tax to somebody if I can replace the cash flow, but I personally am very nervous. And it's the road less traveled. When everybody's doing it, you get out, and when nobody's doing it, you get in. Now, that being said, in every market, there's always an opportunity. You just got to dig a lot harder. So we're digging a lot harder.
I would agree with that.
Rainey,
Can you say anything about Park DIA?
better defer that one to Kevin.
Thanks, Darren. Park DIA is a tremendous long-term asset. There's the fundamentals are secure. The fundamentals are actually getting better through what's happening at DIA and as they start to cannibalize their own parking and raise rates. So it's a tremendous long-term value and asset. Unfortunately, right now we're at Mother Nature's mercy, and we continue to push. We're extremely frustrated with the lack of progress from the master developer on the road. And right now it's all weather dependent. We're hoping that as soon as this weather, this unprecedented weather that we're having in May, once this breaks, we have everything teed up. The master developer has everything teed up to break loose and finish and get started. And we're very confident in what we've done as far as our facility there, our positioning. We're ready to market the heck out of this thing and launch our mobile application and hit the ground running. We're hopeful that that's going to happen within the next month or so. It's right now it's a mud pit out there, and so unfortunately it doesn't drain. Colorado isn't. Our soils aren't used to this type of moisture, so the soils just really hold it, and it's waiting for the air to evaporate it. So unfortunately we're not in Texas or Seattle where those soils drain and you can pave over it because it's the maybe sandy soil. We have clay soils out there, so it's very dependent on being dry, compacted, and there's a significant amount of work that goes into that. So I wish I had better answers on that, except that I know long term this is a tremendous asset, great location, and once we're up and operational, we will manage this to its full potential.
So we actually have a parking lot that we could open today. We just need a boat to get to it. I wake up every day. Even this morning, I thought the rain was going to be over on Tuesday, and then it says it's going to rain, till a week from this coming Sunday. And I just feel like it's never going to stop raining or be cloudy here. But it's the most frustrating thing in the world. So, what else? Great questions. I've got one actually for the guys I put together. So, feel free, whoever wants to take this. My question is at the company level and at the real estate level, what do you see as the greatest opportunity in the next few years and the greatest challenge for you guys?
I'm going to take that one. All right. We've talked about at the real estate level, cap rate changing, the frothiness of the market, whether there's enough capital with the debt markets to satisfy. So I think it's pretty clear at the real estate level what we're going to do. We're going to try to look under the rocks to find all the best assets. At the company level, we've done a lot of things in the last couple of years. Darren alluded to it in his opening slide, really trying to create a sustainable, enduring organization. We have a great team. We've looked at our lines of business. We're a fully integrated organization. We develop, we property manage, we asset manage, we do acquisitions, we do financing. And we do that intentionally so that, A, we can manage the process for our own assets. We can provide some third-party opportunities, financing. Jeff's out looking for financing opportunities with other real estate. But more so, everything goes in cycles. And so if we're not transacting, we're property and asset managing. And so we've really tried to organize the company so that we can be cash flow positive, ability to attract and retain really good talent, and look to grow the company. It may not happen in the next 6 months. We may have to throttle back a little bit on the acquisition pace. But we've got a great team. We've got a secure organization, and we're investing in the infrastructure. And I think things are really good for the organization right now.
I would say in the development side of the business, at the real estate level and at the company level are really intertwined, because we never want to grow the development group to an unsustainable level where we're forced to do bad deals. We'll never be in that position. So we've remained small, nimble, and opportunistic. And so we really can go after just about any different type of deal, any size deal. And we're really branching out to utilize our internal strengths really at the organizational level to outsource construction management, to start to do some joint venture opportunities, even build-to-suit medical office buildings. So thinking a little bit outside the box from where we have been, but again, trying to give what the market is, or listen to what the market is giving us, and not try to force it.
On the acquisition side, I'd add that we're seeing so much of our competition be very, very aggressive on their pricing, and they're using very aggressive, I'll call it debt, with a lot of interest only built in there, a lot of floating rate debt, short-term debt, and that allows them to go and pay more than they probably normally should, but they're doing whatever they can because they've got money to place. And that means we're losing out on deals right now. But you asked a question about opportunities. Once the tables turn a bit, I think we're going to have a lot more fun when we can go out and buy, because they're dealing with a lot of their problems.
So I'm curious about competition. You mentioned it a couple times. Who do you consider your competition, and who do you sort of measure yourself against? And maybe that depends by market, and I'm curious to get your thoughts.
Competition, we're seeing it all across the board. We're seeing, as Darren mentioned, international competition. We've got regional players, national players. We're looking at different asset classes, some that REITs will jump in and play at. We're looking at one in Michigan right now that you might actually have some REITs jumping in there and probably won't get that asset because they've got lower thresholds, yield thresholds. And then there's other deals when we're in tertiary markets where you might not have as many players on there, but they might be more local to that state or to that region only. So that's a lot of our competition. As far as who we compare ourselves to, I don't think we really do that. We always try and improve our operations so we can buy better, but we don't have one company out there that we say, this is what we're striving for.
Given the tenor of the market right now, how many projects do you think you'll put online in the next 2 years?
I think in the next year, through the end of 2015, I'm hopeful that we close 2 more projects on the acquisition side. And I think our goals and what we've talked about loosely in-house is that we close 1 per quarter in 2016, but it's very market dependent. I mean, if we see a drop in prices, that all might change, and we might do 3 times that, or if it extends out beyond that, we might not do 4 next year.
On the development side, we look to carry 1 to 2 projects every year, putting 1 into place. But again, same thing. It's market dependent. We're not going to force it. We're underwriting multiple deals a week, construction costs until those stabilize. Certainly here in Colorado, we don't want to be the last person of the party either.
Get a question over here.
Yeah. Would you say that the company's very much in a sell mindset based upon the hot market and the fact that there's people out there that are willing to overpay, and maybe the 1031 opportunities, to your point, about getting out of a certain product into multiple projects that may be a lower yield, but overall, because of the money that you're pulling out and then able to acquire multiple projects?
Great question. I think I would characterize it as we're pruning our portfolio. That was the best way to characterize that. Look at the assets that we feel like we've maximized, that if we were going to refinance, that like Town Park, by way of example, if we were to refinance, we could have gotten 50, 60% of our money out of that, but our debt service coverage would have been about a 1.4. For that kind of asset, too much risk for me. You know, I come from the lending side, so it just seemed like too much risk. So I would say opportunistic. Is probably the best word, improving the portfolio. Take some chips off the table, move into, better locations. When the storm hits, you're always better to be at ground zero than you are, to be in the outfield.
So then, on the heels of that, are these buyers approaching us, or is that something that we would actively have to go out and market these properties in order to attract?
Combination of both. So get unsolicited calls all the time from brokers, from owners. I don't know that anybody's selling their property off market, if you will, today. You'd be nuts. Why not have, create an auction out there and, with all the money that's chasing it. There are other 1031 people out there as well. And some people, have 30 million. They absolutely, it's been their second or third trade. They cannot pay tax. So it's tough out there for those A locations.
When you look into your market crystal ball, when do you see the next buying opportunity coming?
Well, Luke went by the one slide that said the next, depression's coming in May of 2017.
Not depression.
Recession. So he skimmed over that.
Yeah,
maybe it wasn't that quick.
Yeah, it was a subliminal in there. So I don't know the answer to that. Is it 12 months? Is it 24 months? Is it later this year? Anybody's guess. I think the point is we want to be protecting ourselves, getting the house in order, protecting ourselves, and be ready with powder dry.
So to further that, I didn't want to show this slide. I mentioned it in our annual newsletter. In 2005, 6, 7, and 8, it really started cranking the CMBS loans that Jeff alluded to. There are people out there, and I know one in particular, that have 3 loans, one in Las Vegas, one in Phoenix, and one in San Antonio. And she fed these 3 properties $1 million in 2014. CMBS loans, over leveraged. Why would you go to the CMBS lenders back in 2007 when Fannie Mae and Freddie Mac? Because they didn't give you the loan proceeds that you needed. So you kind of reached, if you will, and cranked it up. There's so much CMBS debt coming due in 2016, 17, and 18 that if interest rates go up and people cannot refinance out, that'll be opportunities to buy partnerships out, to, it'll be a feeding frenzy. And to me, in a perfect world, we lock in all of our debt, any of the floating rate, bridge stuff, we put that to bed, and we wait. Maybe the opportunity doesn't happen, but I would rather be prepared than not be prepared.
A lot of construction loans coming due as well.
Absolutely.
I'm waiting for you. Oh, thanks. Second half, I'm part of the forum group, obviously, and I've been working for 6 years on the forum, construction management stuff, and as the development pipeline stuff has slowed down, I'm looking and talking to many other developers and seeing what they've got going on. One trend I would tell you to keep a look on is micro living, tiny homes, tiny apartments. You're seeing a little bit of that in this market where folks are buying hotels and converting those into, and so part of solving the affordable housing price going up is people are willing to live smaller just to keep their coupon down, if you will. I've worked with a gentleman that started a company called Sprout Tiny Homes, and he having struggled selling his product because the land use ordinances in municipalities don't know how to handle tiny homes, and so you're seeing a lot of now municipalities, particularly in the rural areas right at the moment, changing land use codes for accessory dwelling units, where you can put an in-law cabin in your lot, or some things where if you got a parent or a child coming back and struggling to meet the rent somewhere, it's can I put them in my house, but not in my house, but I put them in the garage, if you will, but it's not a garage, it's called in-law unit. But what we're seeing, whether this is a deal that won't be something that I would bring before and that we would then pick out the still doing feasibility studies, is this a fad or is this a long-term deal that solve a market that's affordable in workforce housing. And so one way to deal with the price deals is people are willing to live smaller, just again, keep their monthly rent down. And so I'm deep in a feasibility study now that if it looks like it's something doable, I'll bring it to the committee here and we'll see if that's something that would be not a lot of track record of history on the product to determine is it, sustainable, is it long term. There's a huge movement. You see shows on TV and you're seeing it in urban areas and the micro living and the smaller units in urban areas, just these tiny home deals. The other thing that municipalities are trying to do to offset the cost that Kevin's talked about, it's so cost prohibitive right now, is what will they do to help either waive tap fees or what other government type incentives that at a municipal or state level, if you're an enterprise zone, it's a state, or what can they do to waive to help developers put in product that their folks can afford. And what we're seeing is a real trend of smaller stuff because bigger stuff is just not affordable as the price pressure goes up around it. So we'll know more about that. I'll bring this stuff to my group as we study this a little further, and you may hear more about it from us or others, but I suspect you're going to see and hear a lot more about micro living and tiny homes.
What are you talking about? Excuse me, what are you talking about in terms of square footage?
250 square feet up to 600 square feet. And it's like living on a boat.
It is.
Very good materials.
Do 2 steps.
This one model we're working on is the bathtub under the floorboard. Again, whether it's long-term feasible economic trend, but we're seeing a lot of it and a lot of people in support of it. And it's needing to have, we have to use land use codes to know how to deal with it. And from, if it's a single-family home and they can be rented or sold, you don't need the standard lot size you do in a normal single-family home. Tighten it down, and then the tap fees are, because there's less demand for water, the less enough tap fees, and make these costs kind of come back in line. They're so prohibitive right now.
So, sorry, just because of time here, I think we got to wrap it up. One last question.
You're seeing a peak in the multifamily markets. Is that also for the industrial resident, or excuse me, industrial, commercial, and also special use as well?
I would say we probably know more about the retail than anything, not industrial or office. We're obviously building an office building for Google in Boulder. Otherwise, we're not office developers unless we have a tenant or tenants like medical office. Construction costs are going up. There's capital chasing everything everywhere. Private equity folks we talk to, every type of commercial real estate, but multifamily is the darling for sure.
I do know industrial use in Colorado specifically, we all know why, is those costs are going through the roof as well, both on the acquisition and new development.
So thank you guys for your questions. Appreciate you guys being interactive.